Hello and welcome to our discussion on financial statements. We are trying to understand the financial statement as a prelude to undertaking a detailed financial statement analysis, and we're taking the example of Apple computers. So we have seen in the last session we converted this balance sheet into a condensed balance sheet wherein is the certain items on the balance sheet are combined together and put into one category, like current assets or non-current assets, current liabilities, non-current liabilities, and equity. So all the items of the balance sheet are converted into these five broad categories. Now let us answer a specific question. We can have several questions with respect to Apple. So undertaking FSA is trying to find an answer to a question relating to Apple by using the information given in the financial statement. For example, if we put this question, we want to find this answer: is the company using current liabilities to finance the non-current assets? In other words, so we want to understand how is the company financing its assets, and is the company using some current liabilities to finance the non-current assets? Normally, the conventional understanding is the non-current asset should not be financed by current liabilities. So, if this is a question, that is the company using current liabilities to finance, then we can find that answer by calculating the working capital. Working capital is the excess of current assets over the current liabilities. So the excess of current assets over the current liabilities, in this case the company is having $29,000 million as a positive working capital. So positive working capital means the company, a part of the current assets are financed by the current liabilities. So the current liabilities are able to finance a part of the current assets only. So where is the balance coming from? The balance is coming from the non-current assets or non-current sources, which may be non-current liabilities or equities. So, in case of Apple, all the 3 years, the company is having positive working capital. But it's possible that some companies may have negative working capital. The negative working capital is a situation where the current liabilities are more than the current assets. In that case, a part of the current liabilities is said to have been used for acquisition of the non-current assets, or the non-current assets, part of the non-current assets are said to be financed by non-current liabilities. So working capital can be zero, working capital can be positive, can be zero, or can be positive, or can be negative. Working capital can be positive, working capital can be negative, and working capital can be zero. So in other words, if working capital is positive, which is the case in Apple, the part of the current assets are financed by the non-current liabilities and non-current sources. But if the working capital will be negative, that means in fact part of the current assets are said to be financed by the part of the non-current assets are also said to be financed by the current liabilities. There are many cases where you can see the working capital becomes negative, particularly in case of FMCG companies, and also in some automobile companies. When we pick up some companies belonging to those industries, we will see the working capital to be negative. However, in case of Apple, the working capital is positive That means the company is not using current liabilities to finance its non-current assets. So then, how it's financing its assets? We can also answer that question by creating a common size balance sheet. The common size balance sheet converts every item into percentage. We can see that 35% of the total assets are current assets, 65% of the assets are non-current, whereas only 21% of the total sources are current liabilities. So that means out of this 207,000 assets, only 43,000 or 21% of these assets are being financed by the current liabilities. So where is the balance current assets coming from? The current assets are said to be financed by these non-current sources, that is either non-current liabilities or equity. Of course, it's well known that Apple, being a most profitable company, it is equity driven company. A significant part of the business in case of Apple is being financed by equity, which is a non-current source. So therefore, to summarize, working capital is a tool which can help us in answering this question, whether the company is using current liabilities to finance its sources. Thank you very much.